Welcome back. Joining me now is one of our favorite Bitcoin analysts, Dylan LeClair. Dylan, so nice to see you.
Natalie, I'm excited for this. Thanks for having me on.
All right, well, Dylan, coming up, we have a special report on the crypto contagion, and I know it's something you spent a lot of time tracking and sounding alarms about, even before we saw the crash of things like Luna and the withdrawal freezes. So what's your overall takeaway from what we saw with these over-leveraged companies and how they impacted Bitcoin?
Yeah, so first of all, it's interesting because you have things like Luna and UST and kind of a lot of the altcoins in the space that I think a lot of Bitcoiners choose rightfully to ignore or just not take the time to learn about. But unfortunately, a lot of these things and the leverage inherently built into them have a kind of an impact on the Bitcoin exchange rate. So with UST and Luna, obviously there was tens of billions of dollars of kind of value that just went poof in the matter of days. And so I think that for me, like just right after that collapse, it was pretty evident that there was a lot of funds and companies and treasuries in the space. And the exact players weren't yet known, but that had exposure to Luna and or UST. And because of that, I kind of, as that was all going down, I was saying like, hey, some insolvencies and some counterparty risk. Like these are the things to watch out for. And ultimately that daisy chain of leverage took out Three Arrows Capital, Celsius, and left a lot of these lenders with billions of dollars of losses. It wasn't known. The crazy thing was it wasn't known just how much unsecured and under collateralized lending was being done in the space. And so while in a bull market, these things can work and you can get away with it, and speculators can be enriched with these practices, in the bear market, the tide's washing out and blowups happen. So Bitcoin probably wouldn't have gone as high up without all of this unsecured lending and leverage, but at the same time, it's all been washed out for the most part. So it's a net, not negative or positive. It's just kind of it all nets out in the end.
Yeah, it's real capitalism at work. But is the pain over, or do you think that we could see more dominoes fall if, say, Bitcoin and the markets go lower?
Yeah, I mean, I think in terms of the crypto native contagion, if you will, a lot of that's past us. It's behind us. Ultimately, right now, Bitcoin is trading just in line with equities and the Nasdaq. It's kind of riding the overall liquidity tide, which is fine, and it's kind of a natural development in its monetization process. So the real question is whether risk assets in general have bottomed, and that's a question that no one really can answer. Obviously, there was some reaction to the Fed meeting today. With a 75 basis point hike and markets flying higher. But in terms of risk markets having bottomed, entirely, that's yet to be known.
Well, let's talk about the number of diamond hands. What is the percentage of people who are hodling, and how does it maybe compare to, 2017, 2018, when we were honestly around the same price?
Yeah, so I mean, it's pretty interesting because going into this market, Bitcoin is such an inelastic asset, as we know, right? 21 million. But because of the supply inelasticity and the pattern of hodlers, both to the upside and the downside, Bitcoin is very reflexive. All right, and so that kind of feeds in to the whole leverage dynamic, like we talked about. But when there's just even a small amount of demand for a relatively, for an absolutely scarce asset where there's the free float isn't all that high, price soars. And similarly, as a lot of sellers, particularly forced sellers, come into the market, price can go down, pretty strong to the downside as well. So I still think it's pretty remarkable that 64% of Bitcoin, this percentage of supply, haven't moved in the last year. So this is like pretty close. We're not at all-time highs, but it's very, very close to an all-time high level of Bitcoin that have been held for over a year. So while there's certainly a ton of metrics we can look at, in terms of diamond hands, most hodlers look to be pretty unfazed, and the average Bitcoiner who's been through a cycle has seen multiple 80% drawdowns.
That's right. I'm one of the bullish diamond hands. So, well, on a macroeconomic level, you shared an interesting tweet. We're going to put it up. You said, seeing a lot of bottom calls lately. Here's US total stock market value to GDP relative to historical standards. Can you tell us what we're seeing here?
More broadly, what you've seen over the last 20 years and really going into 2020, 2021, following the record amount of stimulus that the Fed interjected into markets, you saw equities as a percent of total US GDP go to all-time high levels. So it was over 200%. So the total value of the stock market relative to the US GDP, gross domestic product. And so that wasn't really sustainable. But I think what we're looking at is when you look at equities, bonds, real estate, were in this everything bubble, right? Where rates were low, debt levels are still astronomically high, how is this kind of imbalance going to be solved, right? And so it's still very, very elevated relative to historical standards, around 170% equity market cap to GDP. And so it can go a lot lower. The real question is, given how high debt levels relative to GDP are, and how over financialized the US and really global economy is, what's the level of pain that can be felt without the entire kind of house of cards falling down? And so I think that Powell and the Fed is really walking a tightrope here between, kind of hyper asset inflation and global deflationary bust. And they're trying to walk that line, and we'll see if they're successful with it. But I think the end game here, like always, is perpetual kind of monetary stimulus and more intervention into credit markets.
Exactly. It's just a question of when are they going to print again. And right now there's a debate as far as whether we're in a recession. I know you've been tracking what's happening with the labor market turnover. So what can you share with us on that front and how that might impact the markets going forward?
In terms of recession, the technical definition is something that the White House will like to bicker about, but certainly consumers are feeling it in their margins. You've seen rates fly upwards, so mortgage rates are very, very high, along with kind of sky high real estate prices. That's not helping the consumer. The high inflation is going into everything from energy prices to food. A lot of stuff like that is supply inelastic relative to demand, right? So people need food, they need gas, and so to the extent of how much we see in terms of real productivity decline, I think that's to come if we do see it, and the economy will continue to deteriorate with these higher rates and the debt levels. And so I think that's ultimately why I believe a pivot is a necessity at the end of the day, whether it comes late 2022 or 2023. The market's saying 2023, but I think whether it's a recession now or later, I think one is coming, and we'll see to what extent the labor market and really asset values, particularly real estate, kind of feel the pain here. But certainly, I think the response on the other side of the recession and whatever pain is being felt is gonna blow some socks off in terms of just the scale and scope of it.
We hope you enjoyed that interview. Make sure that you like and subscribe to the Swan Bitcoin YouTube page so you don't miss out on any hard money content.